Nirmal, ladies and gentlemen. I'm Hirogatia. We have with us Manish Singh, CFA CIO at Crossbridge Capital, joining in. Welcome to the show, Manish, and always a
My
pleasure to
pleasure.
speak to you.
Thank you.
Manish, my first question coming to you is the most recent, macro data that we've got is in terms of the U.S. inflation numbers, basis which now you will look at, what the Fed will do as well in terms of the coming meeting. What's the sense that you pick up?
In my opinion, the US inflation has peaked, and any number that you're going to see, and as even the latest number showed, it is trending down. Now, what happened early this week, the expectation for the year-on-year CPI was at 8%. It came as 8.2. But let's not forget that it is lower than 8.5%, which was the last print. So the trend is very clear that the inflation has peaked in the US. It is coming down. The only question is, how quickly can it come down? So I feel less concerned. In fact, I'm getting more bullish now, because if I see the inflation has peaked, then at least that is less of a concern. The bigger concern is that if the Fed still continues to raise rate, and I fully expect them to raise rates on September 21st when they meet, and if they overdo it, then economic concerns start mounting up. Will there be a recession, and how that is going to hurt earnings? In my opinion, I don't see Fed really causing a recession. They will, however, not come out and just say they're going to pivot right away unless they see a change in month-on-month number. Month-on-month number, which was 0 last month, came at 0.3, if I'm not wrong, this month, or maybe 0.1. Now, so month-on-month number has to trend down as well before they start pivoting. But let's not forget that Fed has already used the word neutral rates at the July FOMC. And why did he use the word neutral rate? Because he will be concerned that the debt service cost on US government debt is going to mount if rates continue to rise. And we're not living in 1970s. In 1970s, the debt to GDP was 35 or 40% percentage of GDP. Now it's over 100%. So there is a debt that needs to be paid back, interest on that, and that should not go too high. So in my opinion, you will see moderation going forward in the next quarter. US inflation has peaked, and I see it trending down.
Right. So, taking that into consideration, how do you think will it augur in terms of emerging markets like India?
So there is the good news is that it should mean that US dollar is not going to keep continuing the strength that we have seen. It doesn't mean that US dollar gets weaker immediately, but any halt in that is going to reduce the risk premium, because if you think that US dollar is going to be stronger and then energy price is going to be higher, then immediately it starts affecting emerging market, because people start pricing in higher risk premium to go long India or emerging market. Now, both in these cases are looking favorable. First, you are seeing the energy price is trending down, and the US dollar strength is going to stall. So that should reduce the risk premium that anybody looks when they invest in emerging market or Indian market, and that should be good for the domestic equities.
Right. So, say hypothetically, if the Fed increases rates by another 100 basis points from here on, do you think that is something that we will react to?
So if you look in terms of asset prices, everyone expects Fed to raise rates by 75 basis point this month. So that should not come as a surprise. I don't see them doing 100 basis point. I think that there's lots being said and written about by different people, but I think we've had 275 basis point increase already. Now, as you know, these rate takes time to affect and impact the economy. If you're sitting at the Fed, you're not there in a game to keep raising month every time you meet. You need to see the impact of what you have done already, so you don't overdo it. The last thing Fed wants, or the US government, anybody who responsible wants, is to cause a structural problem in the economy by destroying some of the businesses. I don't think that they are in that business. So I personally don't see 100 basis point increase. I do see 75 basis point increase, purely because the market expects it. And which central banker, if they have an opportunity to raise rates, are going to let it go, because they want these rates to be higher. Just last year, everyone was struggling about how are we going to get out of the zero rates. Now we are out of that zero rates, and the central bank has an opportunity to get it slightly higher. They will use that opportunity. But you also have QT, the quantitative tightening happening in terms of balance sheet reduction. To me, that itself is the 50 basis point rate increase. So how much more rate increase can the economy take? So I find this whole 100 basis point increase completely in outlandish territory. I don't think it's real. I don't think Fed is will be responsible. Of course, just like people swung in one direction, when the rates were zero and saying rates are not going to increase. And you remember Fed made this point, I think, comment last year, or some point early last year, we're not even thinking about raising rates. I mean, with hindsight, that was a silly thing to say, and it has been proven by the fact. So they made that mistake swinging on one side. I think that the mistake is happening again, probably in swinging on the other side. But I think it stops at some point, after the 75 basis point increase. I don't think US can really tolerate. In my opinion, the normal rates or neutral rates in US should be around 2.5%. We are over that, and we will be over that. But you can be over that for 1 or 2, even 3 quarters, so long as in normal term, you're going to revert back to that. I don't see 100 basis point, but I do see a rate increase happening because, well, the market has priced in.
Right. So, in fact, I was just reading a couple of reports where clearly, Manish, fund managers are of the opinion, or maybe global fund managers have turned more bearish on global growth, one. And clearly, they are bullish cash, bearish equity. Now, if you're taking that into consideration, and if you see the cash levels as well, they're now at almost 6.1%. And again, it's a long position on the US dollar. So clearly, investments in dollar versus any other asset classes is what is being considered. What would you have to say to this?
So I would say two things. First, you have to always ask yourself, what is the time horizon of these investors? Because a lot of time your position depends on how long you are investing for. What's your time horizon? And this is where each investor has to have their own time horizon in mind. People who listen to this call, they need to make their own decision. Is that what is the investment time horizon? Are they looking at their portfolio week by week, month by month, trying to make returns, or are they looking at, well, I want to be up or make money in next 2 or 3 year cycle? Believe it or not, you make most of your money in bear market. You just don't realize it. Because that's when you invest it. If I tell you that you bought something at 100 and that keeps rising to 200, 300, clearly you see that you missed out. But if you get an opportunity to buy it at 40 again or 50, and you think that the story has not changed, imagine where are you going to make money? When you buy things at 50 or when you buy things at 200 or 300, when you keep adding your new cash. So investing really comes down to regular investment into the assets that you like. And the report that you talk about, I believe it's the Bank of America report where they've talked about 6% cash. And I've seen all those reports. And that's absolutely vital because you can see what the market. But when I see people turn very bearish or they're very bearish, to me, it's a sign that the bottom is near or the bottom is in. In my opinion, the bottom in S&P 500 has already happened. And that was in June, which is why we are not seeing the 3600 level. And if you look at the movement over last 3 or 4 weeks, you are seeing a higher lows. The correction, the 5% move in Nasdaq and over 3% in S&P that you saw on Tuesday, and we saw headlines, the 1.5 trillion loss and blah blah blah. But actually, S&P is higher than where it was last Thursday. But there has been a huge amount of negative narrative building by, I'm not saying vested interest, but the fact is that fear and emotion sells, reason doesn't sell, and people like to use fear and emotion to bring out whatever they are peddling. So I would be very careful of such headlines. And if you do see a lot of bearish headlines abounding and everywhere, well, say that to yourself that things are bottoming out. When you see too much of bullish headlines, everyone everywhere bullish, that's the time for you to get out and raise some cash. So I think you have to think in those sense, and think it more as a psychological test of where, if everyone around you is very, very bearish, means the bottom is in. And if your taxi driver is asking you for stock tips, then you know exactly you are at the peak of the bull run where everyone is going in. So I would always say use both, not just data, but also emotion to see how you can make your decisions.
Absolutely. And Manish, to that, how are you viewing China? Because clearly, again, I'm raising something which is a fear that has been raised in the markets with regards to the China real estate market, which could be a source of trouble for the investors. I mean, you are seeing Beijing, which is going ahead and cutting policy rates in contrast to the rest of the world. So, how are you viewing China as a market?
So I'd say that, because China is a managed economy, I think, almost probably 80% or maybe more of the economy is managed by the government. It's the financial stability of the country that matters. And it's not a democracy. They have full control over what is everything is happening. So one has to just keep an eyes open when they go there. When you go there and invest. Personally, I'm not a big fan of investing too much into China or stocks. I think the tech stocks are good because ultimately that's a consumption story and it's a growing story. But look what happened. And I was long some of these tech stocks, and the tech stocks got hammered by what the government did or what they said or what they did not do and they said. So I think that is the risk that you have to bear in mind all the time. I do not do the real estate investment in China, so I don't know how that is being impacted. That is being impacted. But having said all that, you just can't ignore China, given the size of the country, the consumption base that they have, and a huge amount of development, both in technology and industrial, that they are doing. And they are the manufacturing base for most of the European and US companies. Now, that may be changing. I think that is changing. But if you want to be part of a growth story where the stocks are still undervalued compared to the multiples that you see in the US and UK, it calls for having exposure to China. But be absolutely clear that you are going to get slammed down in some sense if something was to go wrong. But it's not different to what you see in India. I mean, you always have a 40-50% correction. But if you believe in there is a growth story, then you go and buy at that time with both hands, believing that humanity survives and people survive and consumption is going to grow. So it's no different. The only added thing is that, well, we have a democracy in India and China does not have. So government can bend rules and change things. And so long as you are willing to take that risk, you will get your reward. And people have got reward in Chinese equity market. But then last 18 months is where you saw the risk happening, where those rewards come with amount of risk which you had to be very clear about.
Right. So Manish, with regards to India as well, do you think we are, as a country, as a market, not 100% insulated, but to some extent insulated from global headwinds that could come our way?
I think India as a market, I think we are partly insulated, not fully, because nobody is fully unlike the US, where as 80% of the S&P is basically selling things internally. I think if we have a developed market, both in terms of consumption and produce, then of course, I mean, China has that. So you look at China, it exports a lot of things, but a lot of the domestic consumption needs are met by domestic companies. It's not the companies from abroad, which is why there's such a massive trade surplus. So India is developing in that direction. We are seeing that we have more and more of those things happening. And just a couple of things about the GDP report that we got in India the second quarter. While it is good, let's not forget that RBI's expectation for Q2 GDP year-on-year growth was over 16%. So I think a lot of time people just get drawn in by headline. The reason it came such a strong number, 13%, 13.25 where it was, is because of the base effect that the last time the economy contracted badly and it was in not a good shape. And it came. So it's actually lower than what RBI itself had expected the Q2 year-on-year GDP growth to be. So I would be very cautious and not to overinterpret this. But at the same time, if they kept, and again, I'm referring to what RBI has said. I mean, they have said that the capacity utilization is around 75%, which means the capital expenditure from corporates are going to happen. Because if you're a company and see I'm at 75% capacity utilization, and I'm projecting a growth rate which looks very good, then I start making capital expenditure to make new investments. So that ground is there. But again, I think that a lot has to happen on that. Even if you compare the current numbers of capital expenditure outlay that has been provided, it is much lower than what it was, let's say, in 2017 or prior to that. So I don't think that we have fully gotten out of that. But at the same time, it's good to have a stable recovery which can go on for a long time than to have something which is built on a bubble or consumption story or bad bank lending. I mean, I think that happened a lot in the past. Those have been corrected. The corporates are now getting money which they're not going to misuse. They are being more responsible. So I think the quality of growth definitely is better, but India is still not growing at the rate that it should to really be to basically be justify the expectation that people have in Indian growth story.
Overall, if you say in terms of the Indian markets, currently, would it be a time to start buying for a investor? And if yes, what are the sectors that you would recommend?
Sectors, I'm not good at sectors because I don't follow the sectors so closely. But I would say that is there time to buy? I absolutely say that yes, there's time to buy. I think that the pessimism that abounds is quite high. I do not see a big U.S. recession. I probably see a shallow one if they do it. I expect Fed to start changing the narrative. They will stop talking about inflation going down to 2%. They will probably tolerate 3 to 4% inflation, but they will never mention it. They will say that inflation trend is coming down, so they don't need to do a lot. So those things are going to help India. But again, India, as I keep saying, if you're investing in Indian equity, it's about the India growth story. It's the India story, how responsible the government is, how responsible the policies are, what the central banks are doing, what is the inflation outlook, what is the consumption outlook. On that basis, well, it's not bad. I think it's getting better. And so you continue to invest regularly. And I honestly don't believe in timing the market. I think that it is a fool's errand. You get right, and you pat your back and say, oh, I was very good at timing the market. You never were. It's just a matter of luck. So it's a point of being very consistent investors and invest. So at a index level, yes. At individual sector level, I can't comment. Maybe some sectors have rallied too far, some sectors are lagging behind, so you can do your judgment call based on that. But again, generally speaking about sectors, it's a consumption story. So if you are in sectors where you're selling to US consumer, and US consumer Indian consumer, and Indian consumer will keep getting better and coming stronger, then that is going to help them. And of course the capital and the capital building as well. So you can't ignore the infrastructure story. You can't ignore the auto. You can't ignore some of the other high industrial, high manufacturing capacity story which you're going to buy into.
Right. So it would be right to say that yes, we can continue to buy on the India growth story, do not time the markets. And yes, we are in a sweet spot from here on. There is growth that can be anticipated.
I would agree with that. I think that if you are taking, as I said, it's about investment horizon.
Mm.
If you just have a 3 month investment horizon, then probably you will be asking lots of questions. If you run a highly leveraged position, you'll be asking lots of questions. But if you're talking about, am I going to make money over next 2 to 3 year, 2 to 5 year, and my investment horizon is always medium term. So I feel very happy to invest. And in fact, when things fall, then I'm happy to invest more, because for me, I'm not looking for return in next 3 months time. The beauty of investment is the returns come from compounding over medium to long term. Let me give you an example. If I was to tell you that over next decade or 2 decade, you're going to have Russia default, dot-com bust, 2 recessions, S&P corrects 50%, 30%, 40%, once in a generation pandemic, 2 million people die, interest rates goes haywire, inflation runs at high. Would you invest? You'd probably not. Many people would say, no, that's too much of risk to bear. If you didn't, this is 1996, 98, you lost out on 10x return on S&P. S&P was 400, and then you had all these events happen, and S&P today is 4,000. So it's just a matter of perspective. That do you get scared? The way to make money in equity market is not to get scared out of it. So if you get scared out of it, and if you don't invest and you focus only on scare and only on fear, and you lose why you are investing this money, who you are investing this money for, then you will never make return, and you will get one thing wrong and you will swear yourself off, I'm never going to do equity or something. The key to investing is consistent investing over time, and not to be too bothered about short-term thing unless it's very obvious. So if a recession is going on, you don't have to keep investing. You can take a step back, wait for recession to be over, wait for things to bottom out, and then you can, because you already have investments, you already invested. So that to me is investment philosophy that I like to recommend and follow myself.
Absolutely. Very rightly put, Manish. Thank you so much for joining us on the show. It's always a pleasure to speak to you. Get a very different
Thank you.
view than the normal fund managers or investors that we speak to. So thank you so much. Stay safe and speak to you soon again.
Thank you. You'll have a good day.
We do.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.